Hello, this video is intended to help companies that are in the floor covering industry and who are using QuickBooks to run their companies. You'll notice right here that it says non-commercial companies. We're generally talking about retail businesses, multifamily housing, apartment complexes, new construction, things of that nature. Commercial companies tend to use different models where they're doing larger projects over longer periods of time, and they usually use a progressive billing model. That's beyond the scope of this video, so if you're a commercial dealer, this probably won't help you. You can see that we're assuming also that you if you're watching this video, that you already have kind of a working understanding of QuickBooks, that you've been using it, and you understand something about how the screens work. We're not going to get into a lot of the details of QuickBooks, and we're going to assume kind of a working knowledge there. This is part one of a three-part series. This will be about customer invoicing. We'll also have two other videos. One will be on inventory in the floor covering industry, and job costing. So we'll fly over to our next slide here. First of all, we need to kind of define the scope of invoicing in the floor covering industry before we can match that up to how that would actually work in QuickBooks. You'll notice here that we have three separate kinds of invoices that can be used in the floor covering industry. These are basically, the basics. You'll see that there's an estimate, and usually that's given to a customer before an agreement has been made, and an estimate or a bid could be several. You could give 2 or 3 different bids to the same person, with different kinds of floor covering and different rooms. So there's usually an estimate or a proposal phase that goes on with a customer before there's an agreement. Then you have the written sales agreement. We also sometimes call that in-process sales. And this is the point where somebody is committed to buy from you, has chosen one of the bids or proposals, and now they've committed, and usually they will give you a deposit or some kind of a signed contract at that point. The third kind of invoice would be a completed invoice or a completed sell. And the definition of that is that all of the products on the invoice or on the agreement have been delivered or installed with that customer. Okay? And that doesn't matter if they've paid for it or not. But if all the products have been delivered, that's the definition of a completed sell. At this point, on your books, the sales get recorded on your books, and you become liable for the income tax and the sales tax for that sell. Okay, so 3 different kinds: estimates, written, and completed. Now, if we look at how this matches up in QuickBooks, a completed sell would be equivalent to a QuickBooks invoice. A written sell would be equivalent to a QuickBooks estimate, and an estimate is not, there is no match in QuickBooks, meaning that you want to keep your written sells and your estimates separate. Very often in a company, you want to know how many sales you wrote up in a month. Well, if you combined your estimates and your written sells together in the same section of QuickBooks, you won't be able to tell that number. So estimates usually are tracked outside of QuickBooks for this reason. Okay, QuickBooks doesn't have a good match there. So, just really quickly, want to take you through the sales process and show you how this would kind of work in QuickBooks in the most accurate way. Okay, now if you'll just stay with me here a second, we know that maybe this isn't the way that you're using it, but it is the most accurate way to record things in QuickBooks so that your accounting happens properly. And then we'll address some of the issues after this. So first of all, a customer comes in, you give them some estimates, as we've already talked about. Probably track it outside of QuickBooks. Then you get an agreement from them, a written sell. Okay, and it's a three-part process here. You're going to add a customer to QuickBooks. Okay, a customer account. So if they're not already in there, you have to create an account for that customer. Secondly, you have to add an estimate for that written sell. And thirdly, you would add any payments that the customer gives to you, if there are any. And let me just show you how that kind of happens in QuickBooks, just real briefly. So if I come over here to my contractor version, 13.0, this is one of the more recent versions of QuickBooks. So first of all, I'm going to come over and put an estimate in. I've already done my bid, so now I'm going to put my estimate in over here. And let me just show you, I've already kind of written one up for this Mike Shumway customer. I already had the customer account set up, so I already had that set up, and then I added an estimate for Mike Shumway for this plush carpet install. Okay, $1,200 is how much it's going to be. So I would go ahead and save this estimate into QuickBooks. And then the next thing I want to do is take payments for that. Now, as I've noted over here on the presentation, let's see, I think I've noted it over here. Adding a payment to the AR account is incorrect here because you don't have an actual sale on the books. That doesn't come until the next step here where you're going to add an invoice. When you just have an estimate, that is not hitting your books. And so the most correct way to do this would be to add a payment to your customer deposits account, okay, which is a liability on your books, okay, instead of an asset. So if I come back over here to QuickBooks, I've added my estimate in. Now I would skip the receive payments because that puts it to the AR account if you go there and go to your record deposits account, okay. And over here, you're going to record a deposit. You're going to say who it's from. I would go Mike Shumway. Okay. From account, I'm going to choose my customer deposits account now, which is a liability. Let's see here. Right here. This account right here. Customer accounts, or customer deposits, current liability. Okay. And then I would put the amount in here. Let's just say we're going to put $200 down, okay? And then I'm going to save and close this, okay? So effectively, I've put $200 towards my customer deposits. It's going to hang out there until I actually write up an invoice, and then I can apply that to my AR account. Let's say that the customer comes back and gives you another, let's see, $400. So that would give us half down, right? If we did 400. Same thing, you would come over here to the make payments or make deposits. Again, type in the person's name. Okay, from account, this is still going to be customer deposits. Right here. Let's do 400 now, so that will give us half down. Okay, save and close. All right. So that's how you would start off the transaction here. Let's come back over to our PowerPoint. Now the second part of this, we've got the written sell in there. We have customer deposits. In fact, they gave us two deposits, one of 200, one of 400, and they're in our customer deposits liability account. Now you go out and you schedule the job, and the carpet comes in, and you go out and actually install the job, right? And it comes back, and you've completed all the installation for all the products that are on that invoice or that written sell. Now at this point is when you're going to add the invoice to QuickBooks, which is where it's going to be recorded on your books. Okay, and so we're going to add the QuickBooks invoice, and then we're going to add any additional payments. We're going to add any additional payments to the invoice. So usually, let's just say this is a COD, it will be paid in full. And then we'll change all of our previous payments from the customer deposits account to the AR account. Okay, from a liability there to our AR. So let me show you how you would do this whole process here. Okay, first of all, we're going to add the invoice. So you come back, you find the estimate. So here we go. We've found the Mike Shumway estimate here. We're going to go ahead and create an invoice for this. Notice they already kind of have this feature in here. And we're going to do it for the whole entire amount. Okay. Okay, so now there's an invoice on my books for that $1,200. It's actually showing on my GL. Okay. And now I can go in and receive any other payments that I have for that invoice. So let me find my invoice here first. I like to do that usually. So if you go to create invoice, you can find the Mike Shumway. Here's the $1,200 that's now on an invoice, and we can receive a payment here now, and I can put $600 on here, right? Because that was the balance that we created on the COD. So I'm going to save and close. Putting that on there. And then the other thing I have to do at this point is I have to go back and I have to find my other payments that have been made. So I do a Control F because I need to find how many payments that they've already made. So I'm going to say, which account am I looking for? I'm looking for my customer deposits account right here, and I'm looking for this customer, Mike Shumway. Okay, let's find these. And you can see here now, I can see that he's made two payments, one for $200 and one for $400. Okay, so a total of two payments for $600. So once I know how much he made to his customer deposits account, now I can come over and make a journal entry that will change it from customer deposits over into AR. So I come into company, go down to journal entries, and I'm going to make a new journal entry here. And the account is going to be, well, you can see right here, instead of doing it, let me just show you here. So this was one that I already did, customer deposits for $100. So in the customer deposits account, you would debit the customer account deposits account for $600 and credit the accounts receivable account for $600. Okay, and what that does is it moves it out of your customer deposits liability into your accounts receivable. You need to make sure that the date that you do the journal entry for is on the date that you do the invoice. It's not the written sell date, not the estimate date, but it's the date of the completed written invoice. This needs to be on the same day. What that does is it keeps the money that was given to you in a customer liability account during the period until the job's installed. And then after that, it moves it over into customer deposit. That's the most accurate way to keep track of what's going on in your business, in the floor covering business. Okay, so let's get back to our PowerPoint here now. That would complete the whole transaction that we just went through. Okay, that pretty much sums up this whole sales process right here. Okay, now realistically, all of those steps that we just went through, even though it's the most accurate way to account for things and it's how it should be accounted for, the truth of the matter is not very many floor covering dealers go through all of those processes and steps. They take shortcuts. Okay, and it's just because for the most part to track all those steps is way too hard, especially for really small dealers. And so, here's the kinds of, there's a lot of different shortcuts people take, but here's just a couple of the real popular ones. They'll skip the QuickBooks estimate and just make out QuickBooks invoices. So they totally ignore the written sales part and just go right to the invoice. Well, what does that do? That records your sales prematurely if you do it that way on your books. and that means that your sales tax, your income tax, all that is being recorded at the wrong dates, at the wrong times, and can affect when you're paying things, you're mispaying things and misrepresenting what's going on in your business. There's a matching principle that we will go over in the job costing module when we do that video that will explain why that really kind of even screws things up with your job costing and matching your expenses to your income. So it screws up more than just the dates and stuff. It really gives you a skewed view of what's going on accounting wise. And then, another popular shortcut to take is that you're not going to go record things in your customer deposits account. You just put everything in your AR account, right? And skip the whole customer deposits thing. Most people do that, kind of. And the problem is that your AR becomes understated at that point. It's not correct. So, and again, maybe some people don't really care about that, but again, it doesn't give you the most accurate view of what's going on in your business. So, and there are many other shortcuts that people take, but these are just a couple of the popular ones because they don't want to go through all those steps that I just showed you. Okay. There is another issue in QuickBooks and floor covering that you really need to be aware of. And this is a real gotcha, and I'll show you why here in just a second. In these states, the states that are listed right here, it is actually illegal to charge sales tax on an installed floor covering cell. Okay, so if you have labor on your customer invoice, it's actually illegal to charge sales tax. Now, not very many people know that, or what they will do is down here on this third point, they will charge sales tax on the material but not the labor, and that's even a problem. Okay, there are other states that have similar laws that are even more complex to that, where in some states it's things like you can charge sales tax on a soft surface, but on hard surface products you can't charge sales tax. And so it goes down to the product level of what kind of product. And, a lot of times they say it's because you can rip up the floor covering, the carpet, and take it with you when you sell the house. And so therefore they deem it as being sales taxable. There's a lot of complexity to this that I'm not going to really get into right now. So some very complex laws right here, okay? And as I mentioned right here down on the third, when charging sales tax on material, not labor, a lot of people in these states do that because they kind of have an idea of this law but not really sure about it. There's a real problem with this, and if you look at the part down here that says Warren Buffett in the state of Utah, in Utah in 2004, one of the Warren Buffett owned companies and the state of Utah were sued actually because they were charging sales tax on installed cells, and the state of Utah was allowing it. They had actually audited people that were just charging sales tax on the material and not the labor, and were allowing that to happen. They got nailed also. Let me just show you real quick. Here's a newspaper article from back in 2004. The state of Utah had to pay back millions of dollars to tax, or to the people that were overtaxed because they were doing it this way. And so you just need to be aware of that this is a real issue. The reason why I bring that up here is because QuickBooks, we've been looking and doing research, and we just cannot find a very good solution to this issue of not charging sales tax on an installed cell. Even though you don't charge sales tax, the dealer still has to pay tax on the cost of goods sold, on what they paid for the product, right? And QuickBooks just does not have a good way to track this type of a tax. We call it use tax instead of sales tax. And even in their help manuals, it states that there really isn't a good way to do that. So what do we do? Well, there's a couple of things that we can do to try to get around this. First of all, we pay at the source. That means your vendors, whoever is selling you your product, a lot of times they will charge you the sales tax on the invoice, and then they will remit the taxes to the state. And the reason they do this is because there's in some software like QuickBooks, there's not a good way to track this. There's a couple of problems with this. Number one, even if you have it done this way, that still means that you have to manually calculate the difference on your cash and carry cells. Because on cash and carry, now you do have to charge sales tax, and you've already paid for part of the tax when it was paid at the vendor. So you have to figure out what the difference is between those two amounts and remit the extra back to the state. The second item is if you're doing it this way, you're paying sales tax on your inventory, you're paying it too early. As we mentioned before, sales tax is not due until the products are actually installed, and you're paying the sales tax when you order the product. Okay, so that's the other kind of issue there, that you're paying your tax a little bit too early, and there's a lot of mistakes that happen when you try to do this manual type calculation. The website that's mentioned here on the fourth point is something that we did find in the QuickBooks help section, where a company had been pretty clever and figured out a way to track, track on the cost. Well, not on the cost of goods sold, but on the purchases. Track the taxes that would be owed on that, which is very much equivalent to paying at the source. So instead of paying at the source, they just tracked what they purchased, and then they could run some reports in QuickBooks and kind of do the same thing. The problem is with doing this, you still have the three other problems up there at the top: manually calculating cash and carry, paying too early, and mistakes. So the other option is you can just track everything manually, which a lot of people do. As long as you're not doing a lot of volume in your business, sometimes that's a pretty good option. Okay. So this has just been a real quick video on some of the things to look for with QuickBooks in the floor covering industry. We're always looking to improve and to help dealers do a better job. So if you have any comments or questions or things where additional information you think we ought to include with this video, just email me at chad@qfloors.com. Thank you very much.